pleasure to be here. A pleasure to share with you guys some of my work, my ideas, my insights, and I hope it can be useful to you in your trading, in your studies. Uh, you know, I hope to stimulate your creativity with what I'm going to show. And so let's go right in. So, utilizing trend and mean reversion in breadth studies to gauge market conditions. Well, a little bit about me. I've been actively trading the market since 2007. My background is in business and finance. Actually, that's what I studied in college. I also, before I started the CMT, I passed the CFA level 1 exam. But in 2008, I discovered technical analysis, which was a really interesting period. I saw a video of a trader talking about the 200-day moving average and how it started to flat down and trend lower. And he gave a lot of explanations and historical precedents of how this was signaling that a bear market was starting. And actually, it was super useful advice, and that actually saved me a lot of money. And that's where I got hooked. And that's when I decided to pursue the CMT and become a technician. I've done a lot of things in finance, but currently I'm a proprietary trader, and I'm also doing account management and financial advisory to private investors and family offices. Well, this is me back in. I was actually had the pleasure to be in the 50th symposium of the CMT in New York this April, and it was an amazing event. Met a lot of great people, legendary traders. And right now, recently moved to Marbella, Spain, in the south of Spain, and together with another CMT that's living here, it's called Manuel Telechea. Actually, he started before me, and he made me join. But we're looking to promote and grow the CMT Association in Spain, in Europe. Actually, we recently participated in La Salle Finance Week, which is La Salle University is a really prestigious business school in Barcelona. There's me and Manuel. It was a great event with a lot of students, really motivated people, and other investment and finance professionals from Spain and Europe. And we got a really good reception. And actually, La Salle Finance, La Salle University is actually gonna join us as an educational partner with the CMT. So that's great news. And with this, we're looking to grow this in the CMT in other universities and with other investment professionals in the region. The objective for this session, well, you're a CMT and you've been trading. Breadth analysis is a key component to navigate the market. But most people, I think, are really limited to the packaged studies in chart platforms. These studies they're useful for sure, but I don't think they're well suited for each trader's need, time frame, and market techniques. So I wish to show you some techniques on how to gain important insights on the market using trend following and a mean reversion applied to breadth analysis, but using your own tools. Everybody has their own tools, indicators, studies, and I want to show you how you can use your own tools to create your own breadth studies. And with this, you're gonna create a streamlined and data-driven approach to gauge market conditions, custom to your time frame and market techniques. And the goal is that with one glance, with your breadth studies, you can identify in what situation the market is. What's the most probable outcome? If this will allow you to trade with more favorable odds, greater confidence in the time frame of your choosing, by using your own breadth studies that you created and you studied and you developed. And this also is great, I think, because you'll learn how you can exploit your creativity and unique insights on the market with the breadth analysis techniques that I'm going to present. Before we get into that. Basics. Just I think what we're going to talk about here is that markets, whatever the market, they're going to do 5 things. Markets trend higher, trend lower, they're going to move sideways. You're going to get mean reversion when we're overbought, and there's mean reversion when we're oversold. And as you know, these market behaviors happen at the same time in different time frames because of the fractal nature of the market. Market participants try to participate in the market and profit from these 5 things. If your system tells you, the stock is going to trend higher, you're going to look to go long. If it's saying trend lower, you're going to try to short it. It's sideways, you're not going to maybe do nothing, or maybe you're going to sell premiums, sell strangles, and so forth. You with your analysis, you detect opportunities, and then you make an investment decision based on these 5 behaviors of the markets, right? So, the classical thing, technicians have done since the beginning of time is that, with our charts and technical studies, we attempt to detect if the market is at one of those set 5 theses, and then once we decide, okay, the market's gonna trend higher, that's an idea generator, and then we have our strategy to try to profit from that idea. And first, usually when you start, and even a lot of traders still do it, they like to gauge the market and generate ideas in a chart by chart basis. So looking at a lot of stocks, making watch lists, looking at sectors, indices, countries, etc. But this is great. Like you can here we have a chart of Amazon, so you can look at a lot of charts and say, okay, this chart is clearly bullish. Okay, this one is getting better. Let's see, this one not so bullish. So this is it's great to develop your chart reading techniques and study how the market behaves, but I don't think that it's a really efficient approach to really sorry, give me a second here, to really have a big macro-based understanding of the market. It's going to be hard to be systematic, to have an opinion on the market in a chart-by-chart process. Hard to collect data, hard to collect studies just by visual observation. And also, if you don't have a gauge of how the general market is behaving, like the general market, is it trending higher, lower, sideways, in reversion, if you don't have a general understanding of the macro situation of the market, you're going to be vulnerable, I think, to a lot of false signals. Because maybe you've got a great chart, okay, you've got a great chart, whatever, just look at the Nasdaq. Okay, you got a great chart, it's breaking out, but most of other charts are not doing that. Actually, they're turning bearish, so you're gonna go against the flow of the general market, and what probably will happen is that you'll trade a false signal. And there's a lot of studies, but in general, 75% of stocks go up or down following the market. So breadth studies are key because we focus on the big picture and the important signals. We reduce noise and allows us to allows comparisons between different market periods. It's a glimpse on real money flow and investor psychology. And if your individual chart signal, if you're bullish in the stock, is aligned with what the general market breadth studies are showing you, your odds of success are going to be much higher. So when we talk about breadth, I see it as how many stocks are doing X thing. For example, we can say how many stocks are making 5 days new highs. How many stocks have a stochastic that is oversold. how many stocks, for example, advanced more than 2% with higher volume. So you can get so many ideas, and that's where you can get creative. And based on your understanding and your techniques, you can basically invent the breast study that you want. And the idea is that with your breast study, you obtain insight, data, a chart, a trend that supports or contradicts price action, or tries to support certain price action. So it can tell you, breadth can tell you that stocks are going to trend higher, trend lower, they're going to be sideways, they're going to mean revert. So when you're looking at the big picture, I think you get a lot and you're going to get a lot of more signals that have more confidence that they're going to work than just looking at a single chart and thinking that a certain signal is going to work. So what you're looking when you're looking at breadth is money flow. You're looking at a bunch of stocks or sectors or indices. So we're seeing where money is really flowing. So we can see if money is increasing. That's when probably stocks are going to move higher. Decreasing, you can see where the money is flowing, and you can also see divergences and also extremes. If we gauge the breadth and align ourselves with the flow of money, we increase our odds of success. And also when we see what people are doing with their money, and especially at the extremes, and you study these patterns and ranges of money flow that you can get from your breadth studies, we can gauge extremes in investor psychology, which work well for mean reversion signals, and you'll see that in a bit. So here we have some of the most popular breadth studies. The McClellan summation, for example, the percentage of stocks above their 200-day moving average, McClellan oscillator, and the net new highs, new lows in the MISE. So they're all great, and they're the starting point. But I think if you just base your breadth studies on this, you're going to be very limited, and allows you no flexibility. No, you can't really tinker with this. These breadth studies work for certain time frames that maybe it's not your time frame. You can't really do a lot of signal testing or back test or optimization with this. You basically, this is what you have, and that's it. So seeing this, I realized many years ago that I think we can do better, and you can do better for yourself. Basically, something that aligns with your trading techniques, with your time frame, with your way to interpret the market, with your own findings. So, and that starts by your chart. Your go-to chart that you used to analyze the market. Here's mine. Pretty simple. 200-day moving average, a 5-day moving average, and I used Williams accumulation and distribution indicator. So based on this, how can I create my own breadth studies? I mean, this is what I used to trade, and how I gauge each stock. So how do I turn this into breadth studies that have significance for the whole market, and that can give me a big picture approach for the whole market? That was like my quest. And also, like, using your own knowledge that you use in your charts, you experiment and test your own studies suited for your time frame and market knowledge, and you can download the data after you create your breadth studies. You can optimize, backtest, and do all the tinkering you want, and start developing your own ideas that are unique to you, and they're going to be suited for you. So let's advance. So, well, this is the idea. We want to be this savvy investor, looking at the crowd, moving their money from one place to another, and we want to be there, really clinical, smart, and ready to take profit from opportunity. So the examples I'm going to show you are using a charting platform called TC2000 from Worden. I've used this program for 14 years. I like it a lot. It's easy to use. It's flexible. You can code your own ideas with easy language. You can chart scans and conditions, generate signal alerts, create indicators, test signal probabilities and outcomes. Of course, there's a lot of options that exist for this and allow for a similar approach. But this is the one I know, and I'm an expert on this. But I'm sure, like what you see here, you're gonna be able to apply it to your own charting platforms, some way or another. So let's start now looking at a chart. So I like to gauge the market first by its main trend, and for me it's the 200-day moving average. Basically, when the 200-day moving average is moving higher and prices are above it, it's a bullish market, and you should give it the benefit of doubt. That's like basics. I also like the 5-day moving average for a more short-term, momentum kind of entry when the the market the main trend might be bullish, but things really get going once price is above an uptrending 5-day moving average. And for a more intermediate trend, so this is the long-term trend, this is the short-term, I like to use the Williams accumulation distribution. Well, you can read about it if you don't know about this indicator. I think it's really useful because it trends, and also it can show you, it kind of shows you the interior, like the relative strength of the stock within itself. So for example, if you're making new price highs with new Williams accumulation distribution highs, that's a good thing. And for example, you see divergences like here, like this low of the Nasdaq wasn't really supported by a new low in the Williams accumulation distribution. So it helps you gauge which are the strong stocks, and also like once this indicator is trending higher, it's a good indication that the stock will have a sustainable uptrend. Of course, there's going to be pullbacks, but you can you have a greater security that this is going to trend higher and it's not going to have a lot of false signals. So using this as my chart template, I'm going to say, okay, how can I use breadth for this? How can this idea that, for example, the 5-day moving average moving higher it's good for stocks. So what you can do with this program is, like, I can create a condition and I can ask the program, okay, you know what? I want to see that this 5-day moving average is moving up. Okay, and this is gonna be my condition. And I want to I can scan this and it can show me how many stocks have a 5-day moving average that's moving up. But I can also plot this. I can plot this as a market indicator. I'll show you right now. So I'm gonna put it here. Let me select you can select also the universe of stocks that you wanna run this condition in. And it can be a lot more complex than this. This is an example, but I wanna start with something simple. So I'm gonna use the S&P 500 stocks, and I'm gonna plot this as an area. So here we get, this is breadth now, okay? This is percentage. So for example, right now, we have 87% of the S&P 500 stocks with an uptrending 5-day moving average. And well, this is where you start doing your observations, you start tinkering, you can, for example, moving up, or you can start ranking, or you can do extra filters, or for example, you could add a moving average to this study. For example, you can do a 10-day moving average. The thing is that I'm showing you an idea and how I turned something so simple as a 5-day moving average as a breadth study that gives you information of the general market. And with this, you can start investigating and start finding trading rules that actually give you an edge. Okay, so and also something cool, like you could. I'm gonna tell you my rule in this right now, but for example, my rule is that it's bullish if the 5-day moving average is trending. Stocks are 35% plus above their 5-day moving average, then it's a bullish signal. Okay, how did I get this? How did I get to this number? Oh, there's a lot of studies, and I'm not gonna delve into that now, but just take it for granted for now. But once we get over 35%, it's usually a good sign for the market. But also you're gonna see that, okay, so that's and when it's below 35, it's usually a bad thing for the market, that stocks are weak and they can start trending lower. And also you can see that once we get to extremes, the 90% and 10%, the same indicator or breadth study that I just created to show me when the market is trending higher or lower. Sorry. Let me just put this on all symbols. So the same indicator I created to show me if the market is bullish and trending higher or trending lower can also be used for a mean reversion study. So for example, when you're near 90% of stocks have a positive 5-day moving trending higher 5-day moving average, it's a sign of an overbought market, and it's probably we can get some mean reversion and consolidation. The same is when we get below 10%, like over here. Usually when we get below 10%, it's a market that's very oversold. And also you can get divergences, like what we were talking here. We made this lower low in the Nasdaq, but the percentage of stocks with a positive 5-day moving average was 24% here and not 10% here. So you see basically what I'm trying to show you is that with the same idea that you use for your basic chart, the 5-day moving average, if you apply it into a breadth study, you can get so much more information and so much useful information that can help you guide your trading and get a better sense of what the general market is doing. You can get trend signals and you can get mean reversion using just the same idea. Okay, so what I did was basically I did the same thing for the 200-day moving average. So let me go a step back. So this is what I use for a short-term momentum indicator of what the market's doing. The Williams accumulation distribution is what I use for intermediate trend, and the 200-day moving average is for long-term trend. So with my breadth studies, I want to gauge what is the short-term trend, the medium-term trend, and the long-term trend, plus the mean reversion signals. So applying this kind of thinking to the Williams and to the 200-day moving average, I'm going to skip here. Sorry, this one. So what do we have here? Here is a polished version of what I was showing you. But here we have the 5-day moving average study with some polishments, so it's a cleaner chart and less noisy, but same idea. So when we get above 35% of stocks, it's bullish for the market. And when we get to the extremes of 90 or 10%, it's a mean reversion signal. Here in the bottom pane, I have the percentage of stocks that are in a long-term uptrend Let me just erase this. So, and when this number, this rule that I use in my study that I use is when this number drops below 40% of stocks, of all stocks in a long-term uptrend, that usually means the market is in trouble. And this is when you get the big declines like we saw in 2022. We can see here also how this is a really nice way to see how the market was advancing since the COVID low, and how breadth started to deteriorate as we made higher highs. It was not supported with breadth. And actually here at early 2022, we start seeing dipping below 40% and breadth making lower highs. And here you are basically deep in the bear market, and this is when we get the big declines that we experienced last year. Plus, you can see like the trend of the Nasdaq here, below the 200-day moving average. So, and also here in the middle pane, this is the study I did with the Williams accumulation and distribution. This is a bit more complicated, but basically the condition I used here is that I want to see, I'm asking how many stocks are making a new 30-day high in their Williams accumulation or distribution within the last 3 bars. And the same thing for new lows. How many stocks are making new 30-bar lows within the last 3 bars? And then I smoothed it with a 3-day moving average. And what you want to see here is when this is over the red, is that more stocks are making new 30-bar highs than 30-bar lows, and that's a sign of strength. And then as the green line is above the red line, you get a supportive environment for higher prices, and vice versa. Okay, and we can see here, for example, during the last 3 months or so after the peak in July, we see that mostly stocks were making new 30-bar lows continually, and this correlates with the weakness we saw in markets from August to recently the end of October. And so the idea with this is that you can get with one glance and with the rules that I detailed here. So we're gonna have these are gonna be our 3 studies. So the short-term trend, as I explained, the 5-day moving average, the intermediate trend with Williams accumulation distribution, and the percentage of stocks in a primary uptrend with the 200-day moving average above price and sloping up is the long-term trend. So by looking at each of them as a level that triggers them as bullish or bearish. So as I said, 35% of stocks above their 5-day moving average is positive, below negative, overbought when we reach 90% plus, oversold below 10%. The Williams AD, the 3-day moving average of accumulation above the 3-day moving average of distribution is above, so that's positive. When it's the other way, it's negative. And it also, if you look at this indicator, it can give you like a backup overbought or oversold signal when we pass 50%. For example, you can see here, and in March, we reached an oversold condition in the percentage of stocks with an uptrending 5-day moving average, and it also coincided with over 50% of stocks with making 30-bar lows in distribution. So the extreme distribution in the Williams accumulation and distribution indicator, and the percentage of stocks below 10% in with the 5-day moving average. So again, the same breadth study that you can use for trending signals, you can use them at the extremes to for mean reversion. And also it's like when you see these extremes, it's extremes also in investor psychology. If you look at and for example the sentiment surveys, when you see these indicators at these extremes, you're going to see they coincide most of the time with the extremes in sentiment surveys. Recently, we had extreme, for example, here, we were extreme fear in the CNN fear and greed index, I remember, and we were getting oversold signals from our breadth studies. So the cool thing about this also is that you can give them a grade. For example, if this is trending, for example, the short-term trend is positive, I put a 1 in Excel. If it's, for example, the intermediate trend is negative, I put a 0. And imagine the percentage of stocks in a primary uptrend is positive, I put a 1. So out of 3 indicators, we have 2 that are positive. And we can grade the market like this. So we can have 3 very bullish, 2 bullish, 1 choppy bearish, and 0, which is when we have like extreme like bear market conditions. Well, of course, very bearish. And the cool thing about this is that you can every day you can see in what condition the market is based on your rules, right? So right now we recently were overbought actually early this week, and the market's chopping a bit right here, but we're positive moment. Stocks above the 5-day moving average are at 66%. Here we see the Williams, the green line is above the red, so it's positive. And we see 52% of stocks above their 200-day moving average. So we have 3 out of 3 bullish. And we can see how we can do this in a day-to-day or week-to-week or basis, and we can track the performance, our market score, and how it correlates with the market action. And it also makes you just, you don't have to look at 1,000 charts. You don't have to look at 1,000 charts and to get an opinion of what the market is doing. You can just, and this is the streamlined version of and the power of this, that once you apply your own breadth studies that you understand, that you use for your own trading rules, and you apply them like this for breadth, you can get a really quick idea of how the market is behaving just by looking at your 3 indicators. Just you see what level they are. You score them with your rules. You can do whatever you want. You can, if you use all indicators and you have your own rules, your own studies, you grade your own rules, your own studies, and you grade the market based on that. So you get a market grading, and then you can get a track record of how the market is behaving, and your grades and what signals you're getting. So based on this example that I'm showing you, based on these examples that I'm showing you, we can see how this worked during the last year. Okay, let me expand this. So don't get too hung up on these names here. Not really relevant. It's just my own names for stuff I invent. But what I'm talking about here and showing you is about the indicators and breadth studies that I'm showing you right here. So, for example, let's start a year back in November, 22 November, and we had a market score of 3. It was bullish, and actually it was bullish from October. So this is the power. Like if you have something that makes sense to you, and you've tried it, and you prove it to be effective, here most people still were very bearish, but my own studies were showing me like the market was bullish. So we're here in the, let me get November. So 22 November. So this is when the bear market was ending. So market score was 3 back then, and it had been 3 since around here in early November. That was showing you that there was a bullish market. So even though the 200-day moving average of the S&P 500 was still trending lower, my breast studies were showing me that the market was actually getting bullish. We had over 40% of stocks above the 200-day moving average. There was accumulation, and there was a lot of more than 35% of stocks had an uptrending 5-day moving average. So we keep moving here, and here we get, for example, to 9/12/2022, so December. Let's see what happened here. Here we got our first, I think, oversold signal. That was right. So right here, what I'm showing you here is that the market score was not 2. We had some declines in the indicators I show you here, but we reached an oversold signal. Give me a sec. It's easy. It's not so easy to show you through the presentation. So we got an oversold signal, and actually we got a nice bounce here, and then we got a decline. But in this decline in January, the market never got back to bearish, and actually here in early January we were actually bullish, even though the market was here chopping around. In the indicators, even though we had this drop, we see that the percentage of stocks above in a primary uptrend never really declined, and actually momentum, short-term momentum with the 5-day moving average also was maintained pretty positive, and we got and then we started going again at the end of December and January, and we were back to 3. So here we got this rally, and with supporting breadth, and we got up back then. We got one of the first overbought signals here in red. For example, let me see, for example, February 6th of February. So here, right here, we got an extreme move in accumulation that was over 50%, and that's one of the overbought signals that triggered. And actually, the market chopped and pulled back quite a bit, but we really didn't get too much price erosion until here in March, when we had the banking crisis, right? And here we see how the market remained between 2 and 1, but never got back to bearish. So even though this was a tough decline, internally the market still held reasonably strong. And actually here in early March, 14/03 here, we got another oversold signal with the distribution in the Williams reaching over 50%, and less than 10% of stocks had a uptrending 5-day moving average, but the main trend remained positive. So this probably was it's a higher probability signal of mean reversion, and that the rally can continue. And that's what we did, and we got back to positive for this period. Here, and basically, if you see, this is the chart, except for here in June, the market has remained really healthy. And here is interesting what has happened since August. We reached the peak here in July. We we got some overbought signals here when we reached the recent highs. The market, basically stalled a bit, chopped around, but no big declines. But here we see how in August the market started to behave a lot worse, and we start to continually be between 2 and 1. Before we were mostly in 2 and 3. So this shows the weakness that was going behind the scenes, and we can see how during this period the Williams distribution was always dominating the Williams accumulation, and we can also see how breadth started to deteriorate. So even if outside the numerical number that you can get with these breadth studies that you can gauge, it's also important to see actually the chart, like how are those individual indicators showing, behaving. So even though maybe the market is not at the critical bearish level below 40, if you see that breadth is declining and trending down, the Williams its distribution is dominating the accumulation. It's showing you that even though they're not at critical bearish levels that would signal a bear market, the flow of money, you can see that it's leaving the market. It's not increasing like here. That supports this rally. Breadth is expanding. Here, although we're not at negative levels of breadth is declining. So that's another idea for you to consider, that it's good to quantify and put numbers to your signals, but also we are first and foremost, we are chartists, we're technicians, so look at the chart and see what's going on. So this was the tone for the market for the last 3 months. Here and there we've got some oversold signals here, for example in early October, over here, right? And the market bounced a bit, but you can see that it bounced, but it never really got any real buying here in the Williams. And actually breadth was just right at the 40% level, really weak, almost entering bear market behavior, right? So and this was the tune. And actually here in late October we got super bearish. We actually reached a zero here on October 30th. We were oversold. We were actually triggering an oversold signal, but all indicators were at bearish levels. The distribution was above accumulation. We had less than 35% with a positive 5-day moving average, and we actually had dropped below 40%. And what happened the last few weeks, it's pretty remarkable, because here we see how from 1 week to another, from October 30th here to recently to November 6th, the market flipped, and actually we see that positive stocks above their 5-day moving average reached 93%, and the accumulation is above distribution by quite a bit, and we passed super quickly from being oversold to being overbought. And you've probably heard a lot, read it in Twitter or whatever, how we got this breadth thrust, and this is another way you can gauge that we did get a breadth thrust. We passed super quickly from an oversold condition to an overbought condition, and with a lot of participation in breadth, we can see how it improved a lot, and also it shows a really drastic change in character in the market, because before this, when we reached these near 90% levels, the market would chop or the rally would fade, as we see here. here we had a little bit of a consolidation, right? Here we got 90%, we chopped. Here we got a little bit of chop, and then we continue. Same here, same here, same here. This is back in 2022. But right now, look what happened. We reached 90%. We basically went sideways and up to the races. And once again, we reached 90%, and the market is super strong. So what is this saying right now? Well, it's a bit extending. It's rolling over, but we're clearly at positive levels. So if there's some more important consolidation or pullback, market right now is telling you to be a buyer. Well, actually, here I see some questions. Well, the Morningstar. Well, actually, here I'm actually using the Morningstar industry groups for these two indicators, and actually I'm using the S&P 100 for the percentage of stocks around above in a primary uptrend. I gave you an example here using the S&P 500, which is also really good. It's just this is for me a bit better. It's less noisy, but it's super dependent on what you want to do and what market you want to trade. You know, maybe you can do the same studies for small caps only, and you're a small cap trader, or just large caps, or maybe just, for example, bio stocks. This you can apply the same thinking to whatever you want. I don't want you to get too caught up on the details. I'm just showing you ideas of how you can, basically whatever indicator you use, and you can turn it into a breadth study. And what I suggest is you use one for short-term signal, one for medium term, and one for long term, and probably one of those breadth studies will be also useful for you for mean reversion signals. That if you get a mean reversion signal in the S&P 500 and it's in a generally bullish state, the market, and then the stock that you want to trade, for example, you trade some particular stock that small cap, and that stock is setting up well, and it also has some mean reversion signal. It's going to help you a lot to have a higher probability trade. That's the whole idea of this. And also, well, how do you use this? Like, do you go 100% long or short with the score? Well, that's depending. That depends so much on you. I'm showing you basically here a way to analyze, to study the market, to gauge breadth. Of course, when the market has a higher score, very bullish or bullish, odds are that your long trades are going to work much better than in choppy bearish or bearish, right? But how do you use that? It depends so much on your strategy and your risk tolerance. For example, I do a lot of trading with stocks and options. So maybe when that market is with a really high market score, in my case, I'm going to sell premium more aggressively than, for example, I'm going to sell puts, but more aggressively than, for example, if the market was choppy bearish, right? Here I might sell, but I will sell them farther out of the money. That when you enter that kind of discussion, you're entering more of a strategy component of your trading. And what I'm going to show you here is not tell you like a recipe, but more guide you on how you can use this type of thinking for your own studies, for your own analysis, and then you use that in your own strategy. You look for the way to profit from it. Okay. Let me see. I'm reading some of your questions. What books would I recommend? Well, I think, to be honest, I think the best books I've read about technical analysis is the CMT curriculum. I think the way the ideas are presented and organized, I think they're great. And through the years, I think more than the books itself, I've learned more from listening to other traders and seeing how they think and what things they do and what tools they use, and with that I get my inspiration and new ideas. But I think, at the beginning it's important to read as much as you can. But I think right now the internet is such a great place to learn. I think Twitter, there's a lot of great traders. There's a lot of CMTs that share a lot of information and ideas, and watching their webcast and podcasts and Twitter and tweet feeds and stuff, you can get a lot of ideas and that you can work on yourself and develop them. I think it's really important to put the time yourself to observe the market, to see how it behaves, to try to gauge that behavior in rules and in signals that you can create with your studies. Let me see. So I think that's it. I gave you, I think, a lot of ideas, and if you have more questions, I'll be glad to answer them. Let me see. Well, there's a couple of questions. So what indicator is short-term trend, and that's short-term trend for me is a 15-day moving average. There's no secret in that. Okay, they're just names I put to things that they don't mean anything actually. Just look, it's this is a moving average crossover, but doesn't matter. Let me see what else. Well, if there's no more questions, I think we close it up. Well, it was a pleasure. I hope I can get in touch with you guys. You can reach me. Here's my email, victor.riesco@gmail.com. I post quite a bit in Twitter. If you want to follow me in Twitter, my handle is Global Trader. Let me see if I can show you that. So you can. So this is me. This is my Twitter feed. So I post quite a bit, and I like to interact and share with other traders here. So I think it's really cool. And also, if you like TC2000, I recommend it. It's a great software, really easy to use, and you can do so much things, more things that even I showed you here, and it's super friendly. And here's the link. If you want me, you just email me or send me a direct message to Global Trader. This link, if you like the software, will give you a better deal than if you try to purchase it by yourself. It'll give you a big discount. So thank you, and I hope the CMT invites me again soon.
And on behalf of the CMT Association, I'd just like to extend a sincere thank you to you, Victor, for today's presentation, and I suspect this will be the first of many. For those interested, to our audience, today's presentation has been recorded and it will be made available in our video archives a little later this afternoon. If you have any additional questions we could not get to today or that you think of while watching the archive, go ahead and tweet them directly to Victor. His Twitter handle is on the screen right now, or send them an email.
Right.
Any member of the CMT Association.
Of course. I'll be glad to answer and discuss.
Yeah, absolutely. Yeah, so, I'd say Twitter is probably the easiest way to get a response, because then you'll be passing it directly to Victor himself. And then for the CMT Association, my name is Shane Squarick, and I thank each of you for spending the hour here with us, and hope you enjoy the remainder of your day. So long, everyone.